Ladies and gentlemen, I have the great pleasure to talk to a man who has become a friend and a man that I've invested with for some number of years, Mr. Christian Easterday, founder and managing director of Hot Chili. Christian, thank you for your efforts, years of efforts on behalf of shareholders, and thank you for your ongoing support of our investor education programs, including, of course, prominently the Copper Bootcamp.
Great to be with you, Rick, and looking forward to our interview today.
So we're going to start with you giving us a very brief overview of Hot Chili. I know it's been your life's work for 15 years, and making it brief will be tough, but we're going to dive deeper into the weeds in Hot Chili once I start interrogating you. But give us an overview. Give us what it is. Obviously, with the name, you're involved in chili, but tell us what you've been doing with the last 15 years of your life.
Thank you, Rick. Well, as you know, we're one of the most advanced, large-scale, independent copper developers in the world now. The journey started a long time ago, as you know, consolidating a large part of the Chilean coastline down at low elevation in the middle of infrastructure next to port on the Pan American Highway. And over that time, we've assembled a billion-ton resource base, open pitable, and that resource base is now taking another leg up towards a tier one copper asset. We're in feasibility at the moment and looking to put a project into production that has scaled over 100,000 tons of annual copper output and over 50,000 ounces of gold production.
You mentioned at the outset coastal. Explain to our audience why in Chile coastal makes a difference.
Yeah, look, Rick, elevation is everything in the large-scale copper game, particularly when the majority of the world's copper from the Americas come from projects well above 4,000 meters elevation. That makes most of the new supply coming from those type of projects, which is around 65% of new supply, with projects that come with a very expensive capital expenditure tag and a very high operating costs. So when you're down at 700 meters elevation on the coast, you don't have all of those challenges that our peer projects face.
Well, we're talking about infrastructure. I was amused the first time I looked at your deposit on a map to discover I'd driven through it on the way up to Vallenar. Tell us something about the infrastructure that you're gifted with, the Pan American Highway, the power, all that kind of thing.
Yeah, look, it's a blessing to be able to just drive off the double lane sealed Pan American Highway, 17 kilometers out of the town of Vallenar, about 60,000 people. We're situated halfway between La Serena and Copiapó, about 600 kilometers to the north of Santiago. But we sit right next to the main node of the Chilean central grid. We sit next to a port that is constructed and importantly have all of the permitting in place to be able to submit our environmental impact assessment so that we can permit and take advantage of all of those near site infrastructure locations.
So let's talk now about the project. Well, actually, let's not. Let's do something different. What is your approximate market cap these days? How much money are we talking about? What all the assets we're about to talk about? How much are you trading for in the market?
Yeah, we're around 220 million US market capitalization, which is around about the same amount of capital that has been put into this project over the entire journey. That market capitalization has just started to re-rate over the last 6 months. The stock has quadrupled as we've seen copper now moving to $6 per pound environment, and what you're effectively getting is a very, very large amount of the long time frames, the long lead time frames it takes to take one of these projects from discovery through to production. One of the key reasons why we have very little new supply on the horizon for the copper industry. So we're 17 years into that journey for myself, 15 years since we listed, and a couple of years away from financing this very, very large scale project, one of only 5 projects that are available in this size range globally outside of the majors.
Well, we're talking about financing, Christian. How much money do you have left in the treasury? How soon before you have to refill the till?
Yeah, look, we just completed a very successful institutional placement of around 40 million Australian or 30 million US. We've got the majority of that sitting in the till, and we've just recently started expanding our drilling operations over our new discovery, Levae, which is adding a lot of excitement to the story.
We're going to be bothering you about Levae in a second. Let's talk about the existing reserves and resources. What sort of size are we talking about? How much of it is measured? How much indicated? How much inferred? If that's the correct Australian terminology. But describe the size of the prize for us, and describe a little bit about the various centers that you have.
Sure. At the moment, the current Costa Fuego resource base, Costa Fuego, is the production hub that we've been developing. It comprises two main deposits. Our first discovery, Productora, sitting on the western side of the Pan American Highway, some 300 million tonnes, and then Cortadera on the eastern side of the Pan American Highway, 14 kilometres away, another 700 million tonnes. So about 1 billion tonnes total resource base. 85% of that is in the measured and indicated classification, which means that these have been very, very well drilled. They're very mature and they're reserve ready. Out of that 1 billion tonnes, just over 500 million tonnes is within our 20-year mine plan from the pre-feasibility we released to the market 1 year ago, which is now getting superseded very quickly.
And I guess that's an important note, Christian. You talk about a billion-ton resource, and you have 500 million tons in the mine plan. So there's plenty of room to incorporate more material, more time. What do you think the probability is, assuming that you decided to do it? The deposit's plenty big enough. But what do you think the nearer-term exploration upside is?
Look, we've had a very big view of what this area on the coastline could contain. And recently, over the last year, following 5-6 years of efforts to consolidate another very important land holding 30 kilometres to the south over the Damaco porphyry area, we've been successful in securing a project that we had our eyes on for a long time called Levae. So that exploration upside is really playing out now. This is now confirmed our third major discovery within the Costa Fuego production hub. Levae has very, very rapidly shown a lot of upside on size. We recently just, really announced its arrival with a world-class drilling intercept from surface, 725 metres, running about 0.43% copper. But more importantly, showing a lot of very wide high-grade zones. One of those zones, 62 metres at 1% copper equivalent. So this is something very new for the company. We haven't had access to bulk, higher grade material. And so we are certainly seeing that Levae is going to take this project very rapidly this year into tier one category. We currently have 3.5 million tonnes of contained copper and over 3 million ounces of gold at just under 0.5% copper equivalent. That is about to take a very, very material leg up and probably put the company's resource base well over the 5 million tonne contained copper and 5 million ounces of gold.
So let's take this sequentially. The studies that you tabled about a year ago suggested $1.2 billion discounted net present value, importantly, at $4.30 copper, if I'm remembering correctly. And I forget what the gold price assumption that you used was. Do you have any indication of what the net present value would be at today's copper prices? And if so, could you share it with?
Yeah, look, the gold price was done at long term, $2,280 an ounce. So 1 year ago was a long time in the market. Those long term consensuses, and we can talk about spot. The leverage to spot is dramatic, Rick, as you know. Those numbers double on net present value and IRR But if we move to where long-term copper prices are and gold prices are, you're talking about adding another 600 million US of post-tax net present value at that 8% discount rate. And so, we have a very, very strong leverage to where commodity prices on our key commodities have gone. But when you have a double leverage formula, when you're adding higher grade early mine life into that schedule and adding that on top with no additional capital, I once said that when we discovered our second deposit, Cortadera, adding 1+1 in this game gets you an answer of 3. But when you can add 2+1 in this game with our third discovery, undoubtedly we're heading towards an answer of 5. So we're very, very much leveraging up on commodity prices quite dramatically, and now levering with that third discovery, Levae, which is being integrated into our resource base and mine plan this year.
So importantly, Christian, and please correct me if I'm wrong, I'm fairly close to this project, but you're, of course, much closer to it. The value proposition here is that the published mine plan encompasses 5 million tons of a billion-ton resource. The knock on the project was always that the capital intensity relative to the net present value was too high. So the game is quicker payback and ultimately more tons. First of all, you are comfortable that one processing facility will be able, over the life of the mine, to handle all 3 deposits. Is that accurate? In other words, the capital costs, except for normal inflation, don't grow.
Yeah, correct. When you're just simply digging and transporting our third asset, Levae, and adding that into the mine plan, you get that lever against capital intensity. We have a capital intensity of just under $13,000 an annualized ton. So nearly half the capital intensities of the projects in the high Andes, because we're not developing a project at 4,000 meters. We don't require to build a desalinated water plant and a high Andean water pipeline. We get all of those advantages firstly. The ratio of net present value to capital on this project was around about 1-to-1 a year ago. Now we're probably seeing that ratio move from an NPV to capital ratio towards 2. And in this game, that is a very, very strong place to be. We see the IRRs moving from 19% towards 30%, and we see the paybacks reducing from 4.5 towards 2.5 years with the addition of Levae and taking on the revised long-term prices, but primarily the impact of Levae and what that does on capital profile for this project and payback.
Well, let's start dealing with Levae now. The billion tons that we're talking about functionally excludes Levae. Let's talk about the added tons at Levae, but more importantly, let's talk about the importance of the higher grade starter pit and defend the notion that you have the beginnings of a higher grade starter pit, please, because that makes a real impact on early year cash flow and hence payback.
Yeah, sure, Rick. And look, we've been very surprised with this deposit. We started drilling it about a year ago with just simple reverse circulation drilling. Over half of our holes were finishing in mineralization. And then about 6 months ago, we started our diamond drilling program. And that's really, really added a lot of clarity and started to hone in on the higher grade areas of the deposit. Importantly, we've been finding a lot of high grade mineralization over very strong widths, ranging up to 150 meter downhole widths, but probably averaging around about 30 or 40 meter drilling widths from near surface. Typically, those drilling assays over those near surface positions sit between 0.7 to 0.8% copper equivalent. We're very blessed at Levae that we have a very high gold credit in comparison to our billion-ton resource base to the north, and that additional gold credit is easily covering our transport distance. About 0.1 grams per ton of gold covers our transport. And so when you don't have to build a second standalone operation and a second processing facility and all of the infrastructure associated with that. And you can simply just bolt this on, add in a high-grade starter pit, which will easily displace our material in year one of the project with around about 30% better grade profile. Then you're getting a free kick of some 300 million, 400 million US of additional revenue in year one. And in addition to that, out of this very large bulk tonnage resource that we've discovered and we're currently rapidly drilling out to put into our reserves, we see around about an additional 5 years of sulfide higher grade feed coming into the front end. So this is going to take our mine life from 20 towards the 25 to 30 year mine life bracket. Levae is easily going to be featuring in those first 5 to 10 years of production feed on a bulk tonnage basis. And we're really concentrating at the moment on how much material can go into year one and potentially year two. But that's a very big leverage formula on our numbers. It dramatically pulls down our payback periods and gives us access to material that throws off much higher revenue in the outset of the project, which is something that the project is really going to benefit from a financial perspective.
So we have a catalyst-rich 2026. Let me try and summarize it for you, and please correct me if I'm wrong. We have a couple thousand students here who are paying attention, so don't let me embarrass myself. What we have is 1.2B NAV at an 8% discount, importantly at historic as opposed to current prices. But we are basing that on 500 million tons of what is presently a billion-ton resource, but is growing. In addition to that, we have a new discovery to the south that both increases the tons and grades, but importantly front-ends the cash flow. And on top of that, unlike any of our competitors, we have access to water. In fact, access to so much water that some of our competitors will be reliant on us for water. And as I understand it, you will have data surrounding the water, surrounding the starter pit, and surrounding an updated PFS in calendar 2026. Did I get all that right?
Yeah, you did. Very heavy news flow from the drill bit in the first half, and in the second half, major catalysts that are transformational for this project's economics and scale.
The final thing I want to say is our students will have heard elsewhere in the classroom that while NPV is a really nice conservative way to value a project, NPV takes into account the cash flows that take place in the first 10 years. At the end of the first 10 years, if you run the NPV clock again, you started at zero, which is to say the NPV of this project 10 years from now, assuming steady prices, will be the same as the NPV today. Where people go wrong analyzing long-lived mines is the upside associated with exploration, the upside associated with the leverage to higher copper prices, but importantly, the fact that NPV calculations don't include the tail. So when the students of this classroom are using the data that they hear from Hot Chili and others, remember the lessons that you learned in the rural classroom about all of these. Christian, thank you for subjecting yourself to this interview today. Thank you for your efforts on behalf of shareholders, particularly one named Rick Rule. And thank you, too, for your ongoing support of all of our educational programming here at the Rural Classroom.
Thank you, Rick. It's been great to talk again.